Warren Buffett has one number, one single number he calls the best measure of whether a stock market is in danger. Right now, that number just hit the highest level ever recorded in history. Higher than 2008, higher than the financial crisis, higher than anything we have ever seen, except one moment. And that one moment was the peak of the dot-com bubble, right before the market crashed 50%. And if you have money in the stock market right now, in a 401k, in an index fund, in anything, what I'm about to show you directly affects you. I'm going to show you exactly what this number is, what it is telling us right now, and the specific moves that protect you no matter what happens next. I made this channel to make investing simplified. All investing carries risk. Do your own research. This is not financial advice. It is called the Buffett Indicator. Warren Buffett himself once called it the best single measure of where valuations stand at any given moment. He has since stepped back from endorsing any one number as the final word. But here is the thing, the indicator still carries his name. Wall Street still watches it closely, and right now it is screaming. Here is how it works. You take the total market value of every publicly traded company in the United States, every single one, and you divide it by the entire US GDP, which is the total output of the American economy. The result tells you whether stocks are priced fairly relative to the real economy underneath them. When the ratio sits around 100%, valuations are reasonable. When it climbs toward 150%, analysts start paying attention. When it approached 200% back in 1999, Buffett went public and warned investors they were playing with fire. The dot-com bubble burst shortly after. Stocks fell nearly 50%. So where is the Buffett indicator right now? Well above 230%. That is the highest reading ever recorded. We are in the most expensive stock market in American history, and here is what makes that number even harder to ignore. The US economy has been slowing down while stock prices keep racing upward. The real economy underneath them is cooling. That gap has rarely been wider. This does not mean a crash is happening tomorrow. Markets can stay expensive longer than logic says they should, but what it does mean is that the market is currently pricing in a future that must go perfectly. AI has to deliver. Earnings have to keep growing. Inflation has to stay contained. Every single piece has to fall into place simultaneously with no room for error. Back in the late 1990s, the internet was the technology that was going to change everything. And it did, just not on the timeline investors were pricing in. In that moment of excitement, people stopped caring about profits, revenues, or whether a business actually made sense. They were buying stocks because stocks were going up. That is FOMO investing in its purest form. Companies were changing their names just to add .com at the end. No new product, no new revenue. Just a name change, and millions of dollars would pour in overnight. The story felt so good that nobody wanted to question it, and then reality arrived. The Nasdaq fell 78% from peak to bottom. It took 15 years to fully recover. Right now, we're watching a strikingly similar pattern unfold with AI. Professional fund managers, people who manage billions of dollars for a living, and openly warning that AI stocks look dangerously overpriced. The Magnificent Seven, just 7 companies, now make up roughly 1/3 of the entire S&P 500. That is the highest market concentration ever recorded, and the Shiller price-to-earnings ratio, which smooths out a full decade of earnings to give you the clearest picture of whether stocks are expensive, is currently approaching 40. The only time in history it has been higher was at the very peak of the dot-com bubble in December 1999, when it reached 44 right before the crash. Now here is the important nuance, because I want to be fair. Today is not identical to 1999. The major AI companies are generating real, substantial profits. Back then, the majority of internet companies had negative cash flows and were burning through whatever money investors gave them. That is a meaningful difference. But profitable does not automatically mean safe to buy at any price. Amazon survived the dot-com crash and became one of the greatest companies ever built. But anyone who bought Amazon stock at its 1999 peak still waited over a decade just to break even. The technology was real, the price was wrong. That is the distinction that matters right now. Here is what makes this so critical for every investor watching. The Magnificent Seven, the 7 mega-cap tech companies that together make up roughly 1/3 of the entire S&P 500, face an earnings test every single quarter. Meta, Microsoft, Alphabet, Amazon, Apple. These results are not just quarterly numbers. They are the market's ongoing answer to the question everyone is asking. Is the AI spending boom actually producing returns? Or is the world paying trillions of dollars for a story that has not delivered yet? When those earnings disappoint or when guidance turns cautious, The market repricing is fast and significant. When they beat convincingly, the rally continues. Either way, what these companies report each quarter tells investors more about where the market is headed than almost anything else. This is exactly the kind of environment where investors who prepared in advance come out ahead, and investors who are flying blind get hurt badly. What you should do right now. First, build your foundation before anything else. No investment strategy protects you if you have high interest debt or no emergency fund. Aim for 3 to 6 months of living expenses in cash. If that feels far away, start with 1 month. The reason this matters is simple. The true worst-case scenario is not just a market drop. It is a market drop combined with inflation staying high, combined with job losses, and then being forced to sell your investments at the bottom to pay your bills. That is how people get permanently hurt. Eliminate that vulnerability first. Second, keep dollar cost averaging. I'm still putting money into SCHD for dividend income and broad S&P 500 index funds on a fixed schedule, regardless of whether the market is at an all-time high or pulling back. On average, the S&P 500 closes at a new all-time high about 18 times every single year. Waiting for the perfect entry point statistically costs most investors far more in missed gains than any dip ever recovers. Consistency is the strategy. Third, diversify away from concentration risk. If roughly 1/3 of the S&P 500 is sitting in just 7 companies, and professional money managers are openly warning about dangerous overvaluation, that concentration deserves your attention. Spread across sectors, consider international dividend ETFs alongside domestic holdings. Make sure no single story, no matter how good it sounds, owns your entire financial future. The stock market is flashing signals that serious investors cannot afford to ignore. The indicator that Wall Street named after Warren Buffett is sitting well above 230%, the highest ever recorded. The Shiller ratio is approaching levels seen only once in over 140 years of market history, and the biggest companies in the world face an earnings test every quarter that will either validate the story the market has been telling or begin to unravel it. Stay informed, stay positioned, and whatever the market does next, make sure you are protected first. Smart investing, profitable results. This video is for educational purposes only and not financial advice. Past performance does not guarantee future results. Please consult a licensed financial professional before making investment decisions.